Let's finish up this chapter on adjusting entries. The prior video was getting a little bit too long, so we had to kind of cut that off. But that's okay because all of the items that we were really looking at, whether we were talking about accrued revenues, expenses, some type of a deferral with revenue or prepaid insurance assets, all of those were essentially, cash transactions. We were making adjustments for cash we were going to receive or that we had already received. And depreciation expense is a little bit different story. It's the same thing in the sense that we're going to need to make an adjusting entry for it. But I want you to understand that depreciation expense in and of itself is called a non-cash expense. Okay, so whether we buy a fixed asset at a large cost and we pay cash for it, or whether we buy it and put no money down and make monthly payments, our depreciation expense is going to be the same, and it's going to be triggered, at least for our purposes, on the passage of time. Now, we're going to discuss fixed assets or plant assets. These are assets that are used in the ordinary and necessary course of business. We're going to discuss those in greater detail later in the course. But for now, we need to understand just some examples of what fixed assets are, and then which of these are depreciated and which are not, because we've got three examples here: equipment, buildings, and land, but these are not all going to be depreciated. Make no mistake, the passage of time on these assets will create an expense that will reduce our net income. So if we think about it like that, we absolutely must record depreciation expense as an adjusting entry, and we're going to look at some examples on why that is so important. So it says here, as time passes, a fixed asset loses its ability to provide useful services. This decrease in usefulness is called depreciation. Okay, so let's think about this and what this says here. We have to be careful about the way we word stuff with regard to depreciation, because there are a lot of the term depreciation is misused in almost every context that you will hear it out there in the world. Okay, but what we want to say is, if you buy a vehicle, for example, for personal use, and you maintain that vehicle, drive it to and from work, occasionally somewhere else, gosh, a vehicle can last you 10, 15 years easily. But in a business, we might be using those vehicles a little bit harder, even with maintenance. We're putting so many miles on, say, for example, a vehicle that we say, okay, you know what? This vehicle is going to serve our purposes for about 5 years. Okay. And then after 5 years, the cost of maintaining it is just going to be too much. So whenever we say as time passes, a fixed asset loses its ability, another way to put this would simply be that over time, from day one, the clock is ticking. If we're going to get about 5 years use out of it, it's not that there's any discernible difference between that asset when it's brand new and when it's a month old. It's just that we know that overall we're going to have to use it for a certain amount of time. So whatever we paid for it, we're going to depreciate it over that period of time, whether it's 5 years, 10 years, whatever the situation calls for. Okay, so let's get into, again, we're going to talk about depreciation a little bit more later. But let's get into some examples of how this impacts our financial statements by way of adjusting entries. It says all fixed assets except land lose their usefulness and thus are said to depreciate. So think about land. Land's been here for a really, really long time. Whether you think it's been here for 3 billion years or 3,000 years, whatever the case is, that's a very long time. Either number you want. It says, and I've told you this already, as a fixed asset depreciates, a portion of its cost should be recorded as an expense. Okay, this periodic expense is called depreciation expense. So if we go out and we buy a delivery vehicle for $30,000, that is not a $30,000 expense in the year that we buy it. It's not how it works. So how do we do it? Well, let's take a look here. Depreciation expense and the historical cost principle. Okay. It says the adjusting entry to record depreciation expense is similar to the adjusting entry for supplies used. The depreciation expense account is increased with a debit. It's an expense, so it's going to go up with a debit for the amount of depreciation. So it becomes depreciation expense. However, the fixed asset account is not decreased. Okay. So I want you to think about this. We have a delivery vehicle. We paid $30,000 for it. Let's say it's 5-year property. We pay $30,000 for it. If we were to divide that by 5 for 5 years, we're going to have depreciation expense of $6,000 a year. But our slide is telling us that at the end of 1 year, our asset value on the balance sheet is not 30,000 minus 6,000, which would give us 24,000. It's telling us that our asset value for that vehicle is still 30,000. So how does that work? It says this is because both the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. What we're going to do is we're going to use an account called accumulated depreciation, which is increased. So what we're going to show here is the asset at 30,000, and we're going to show accumulated depreciation with a credit balance of negative 6,000. So our net assets would be 24,000. That is a fairly difficult concept to grasp. But really, even if you're having trouble with it, I'm not too terribly concerned about that, because you can still make the depreciation expense adjusting entry. Even if you don't understand this historical cost principle and accumulated depreciation. We're still a little bit early for that. Okay, I want to show you, for those of you who are out there and you say, well, how does that work exactly? I kind of have to tell you. But if all you understand is that you need to make a depreciation expense entry as an adjusting entry, for now, that's going to be good enough. So what we have here is we have a balance sheet for this classy company, and it says depreciation expense and net assets. Now, depreciation expense is over on the income statement, but for the balance sheet, we're going to look at this concept of net assets. We've got some property, plant, and equipment here. Land of 25,000. We don't touch land. But look what we did here. We bought buildings and equipment totaling $150,000. This is more than one asset, the total value of which is $150,000. So no matter how much we depreciate these buildings and equipment, it's always going to be $150,000. However, when we depreciate it over time, we're going to keep a running total here of our accumulated depreciation. So that's a subtraction. So 150 minus 50,000 is 100,000. We add our land to it, and we have net assets of 125,000. Okay. We call this accumulated depreciation account a contra asset account. It is an adjustment account to this account here. If you recall, we discussed the historical cost principle back in chapter 1, and we talked about being able to verify transactions and so forth. Well, if we're going to show buildings and equipment of 150,000, this is the amount that we need to verify that we paid for these items. If we muddle this figure up and just adjust the value of the asset, we can no longer look at the balance sheet. We would be trying to verify 100,000 rather than a purchase price of 150,000. So that's why we do this, okay? This is what I really want you to understand here. Net Solutions office equipment depreciates $50 per month. That means that it's $50 for every month of the year, including December. Remember, we bought that office equipment. What this tells me is that office equipment is being depreciated over a 3-year period of time. How do I know that? Because 1,800 divided by 600 is 3 years. $50 a month, $50 a month times 12 months in a year is 600. That's how I came up with that. Okay, so we buy the asset. I believe it was on December the 1st. I don't remember actually, but we bought the asset for $1,800. We leave this asset alone under the historical cost principle, and we simply, for the 1 month's depreciation, we credit accumulated depreciation right here. Depreciation expense is a debit of $50. This is a given. Okay, so accumulated depreciation goes up, depreciation expense goes up. What happens to stockholders' equity? Stockholders' equity actually goes down, if you can read that as a down arrow. Okay? So what is the impact of omitting this entry? It says if the adjustment for depreciation is not recorded, the income statement and balance sheet prepared will be wrong. Expenses will be understated by that $50. As a result, assets will be overstated by $50. The furniture is going to be $1,800 regardless, but that accumulated depreciation is not going to be there for the $50 credit, and so our net assets, instead of showing up as $1,750, are going to show up as $1,800. As a result, stockholders' equity is also going to be overstated because net income is overstated. Now you may wonder, well, who cares? It's $50. Well, yeah, it is $50. But if we don't make this entry in December, guess what? We probably didn't make it in any of the other months either. If we fail to make it the 1st December, we're probably not going to make it for January, February, March of the next year. And that is going to be a much bigger problem in the next year, because then it's going to impact the income statement and balance sheet by the full 600, right? And if that still doesn't impress you, think about a company that has millions upon millions of dollars in assets. If they do not make the adjusting entry for depreciation, they are going to be paying way too much income tax. Why? Because their net income is seriously, seriously overstated, because their expenses are understated. Okay? So we've got some here. I'm not going to go over all of these. This is just for you to review in the static PowerPoint that you have access to if you're in one of my classes. We have a couple of slides here with summaries of adjustments, and there's some reasoning provided, what we've done, what the adjusting entry is, why we did it, and then what would happen if we didn't do it, if we omitted the adjustment. And we have another page of them here. These are all of the accounts that would be affected just by those few transactions that we've looked at. Okay? This is a journal entry representation. If you worked for a public accounting firm, when you would close the books at the end of the year, you would print out a separate report for any company that you worked with that would be dedicated strictly to adjusting entries to show what you had done at the end of the year. So this is just, notice that the date is always the last day of the year. Okay, This is for your review. I'm not going to get into the nitty-gritty of it. We've already covered these on an individual transaction basis. We have our ledgers. You can probably skip this slide. I think it'll cause more confusion than anything else. Ledgers continued. Okay, so after the adjusting after the adjusting entries are posted, an adjusted trial balance is going to be prepared. Remember, we already did an unadjusted trial balance. Now we're going to do an adjusted trial balance. Okay, now here is your adjusted trial balance. I don't remember the totals for all of these accounts, but I do know that we have some differences here. I know, and some of these are not. Cash was 2065 before. You can go back. I can't remember what slide it was. I believe it was slide 17, has the unadjusted trial balance. This is the adjusted trial balance. So one that might be easy to spot, a couple of them here. Supplies were 2,000, but we made an adjusting entry to show that $1,240 in supplies had been used. Now our adjusted balance for supplies is $760. Prepaid insurance started off at $2,400. After 1 month, though, it's $2,200. What else? Let's see here. Our rent revenue, we had no balance, or it'd be over here. But if we looked at our unadjusted trial balance, we would have nothing under rent revenue on the unadjusted trial balance. Now we have $120. Okay, and there's some other examples as well as we go through here. We didn't have any depreciation expense on the unadjusted trial balance. Now we do. Look here real quick. Remember I told you that prepaid insurance went down from $2,400 to $2,200? It did, but look what went up. Insurance expense, we didn't have anything for insurance expense before. Now we have $200. 200 plus 2,200 is the 2,400. All right, that's it for this chapter as far as the PowerPoint videos. We'll get up some handouts for you to practice on, and then we'll make some solutions videos for those handouts here in a bit. All right.